One of the things that drives me nuts when it comes to whole life insurance is the whole non-direct and direct recognition conversation. What we have heard so many times over the course of I don't know how many years is that if you go with a direct recognition company, when you take a loan, the company is going to stop paying dividends on the amount you borrow. That is nonsense. That's not how it works. When it comes to direct recognition, all companies do things a little bit differently. However, what direct recognition means is that the insurance company directly recognizes the fact that you take a loan against your policy. They still pay dividends on your entire cash value. However, the dividend paid to the borrowed piece is typically different than the dividend applied to the non-borrowed piece. What's very important to note is that some companies do reduce the dividend rate on borrowed funds. However, some companies will raise the dividend rate on borrowed funds. What this means is when I take a loan and then repay that loan, if I choose to repay it, if the company reduces the dividend rate on borrowed funds with the direct recognition company, when I pay it back, I'll see my cash value a little bit less than what it would have been if I never borrowed against the policy in the first place. If the company raises my dividend rate on borrowed funds, what would happen? Well, when I borrow and repay, I would see my cash value a little bit higher than what it would be if I never touched it in the first place. There is a lot to consider when I am looking to take a policy loan, and if the company is direct recognition or non-direct recognition, a very important piece to look at is that loan rate variable or fixed? Usually, not all the time, but usually, if I go with a direct recognition company, I'm going to have a fixed loan interest rate, which is very nice to have in a high variable interest rate environment. So that is an advantage there. But it's really important just to see the different companies, see the different options, try to figure out exactly how I want to use the policy, what I want to take loans for, how long will I have them outstanding. And you can look at illustrations that really simulate how much you would pay in loan interest, and you can see the impact of dividends applied to your cash value when you borrow against it. But in my opinion, the conversation of don't go with a direct recognition company because they stop paying you dividends on the amount that you borrow, I think it's nonsense. Where I have typically heard it the most is from agents or someone speaking with or working with an agent that prefers to use a non-direct recognition company. It's usually used just as a means to compete against different insurance companies. Hope this helps. Let us know if you have any questions. We'll talk to you soon.